All right, let's jump right into this explainer. Today we're talking about the banana economy, a guide to market bubbles. We're going to take something that has baffled economists and ruined investors for centuries and break it down using, well, a surprisingly simple fruit.
So what even is a bubble? To really wrap our heads around this, we need to strip away all the Wall Street noise. Just imagine a super simple life where you buy stuff purely to use it. You need a thing, you buy it, you use it, you move on. Simple as that.
In our normal baseline village economy, a banana costs 1 leaf. You buy it, you peel it, you eat it, life is good. The price makes total sense because the value makes sense. 1 leaf for 1 snack. It's a perfectly healthy market where things are valued for their actual fundamental utility.
Act 1. The Banana Boon.
But notice how fast human behavior flips the second you introduce scarcity. Suddenly word gets out, bananas are getting hard to find. They're rare. And you know what happens next, right? People instantly decide they must be super valuable. They realize, hey, if prices are going up tomorrow, I should probably buy a bunch today, not to eat them, but to flip them for a profit. And just like that, the entire purpose of the banana changes. It literally transforms from a quick snack into a financial asset.
And the escalation gets absolutely absurd. Day 1, we're at a single leaf. Day 2, it's 2 leaves, then 5, then 10. Before you know it, the price peaks at 50 leaves for 1 single banana. Nobody even cares about coconuts anymore. People are buying just the peels because it's all they can afford. The charts are going straight up, local news is giving daily banana tips, and everybody's suddenly a self-proclaimed banana investor, even though almost nobody actually knows why.
Act 2, FOMO and the herd. To understand why prices reach the stratosphere like this, we've got to look at 2 massive psychological drivers. First up, FOMO, the fear of missing out. It's that absolute terror you feel watching everyone around you get inexplicably rich while you're just sitting on the sidelines holding your leaves. People start buying blindly simply because they're terrified of being left behind, and that triggers blind herd behavior. I mean, when everyone around you is making the exact same crazy decision, it kind of feels like the right decision, doesn't it? Classic monkey see, monkey do.
And this kicks off a vicious hype loop. People buy. The price goes up. That triggers more FOMO, which makes even more people buy. Round and round we go. The buying literally just causes more buying, and suddenly the price is 100% disconnected from the actual nutritional value of the banana.
Act 3. The Leverage Accelerant.
Now, psychological hype is bad enough, but things get incredibly dangerous when the banks get involved. Enter leverage. This is when people take out loans to pump even more money into a rising market. If FOMO is the bubble, cheap bank loans are a king-sized air pump, inflating it at record speed.
Just look at the stark contrast in the math here. Without leverage, you risk your own 100 leaves. Market goes up 10%, you make 10 leaves. It drops 10%, you lose 10 leaves. Pretty safe. But with leverage, you put in 10 of your own leaves and borrow 90 from the bank. If the price goes up 10%, boom, you pay the bank back and double your money. But here is the terrifying catch. If the price drops just 10%, your bananas are worth 90, you still owe the bank 90, and you're left with absolutely nothing but debt. The market doesn't even have to crash. A tiny wiggle can wipe out your whole investment. So leverage creates this second, ridiculously fast loop. Buyers pile in using borrowed money, the price rises a bit, their bananas are worth more, so they use that new imaginary value to borrow even more to buy even more. It's a massive accelerant that pushes the price to a staggering 100 leaves for a single banana. We are now officially in a massive, terrifying bubble.
Act 4. The Inevitable Pop.
Because here's the fundamental truth about markets. Gravity always wins. Eventually, someone gets hungry, looks at their 100-leaf investment, and realizes it's just a banana. It literally grows on trees. And that single realization triggers a brutal reverse loop. The mood shifts. A few people quietly sell, the news reports a tiny dip, and then panic. The exact second the price drops, banks issue margin calls, forcing all those leveraged investors to sell immediately to cover their debts. This dumps massive piles of bananas onto the market all at once, crashing the price from 100 to 50 to 10, down to half a leaf. Suddenly everyone's screaming, "Please buy my banana. Why did I put my life savings into something that rots in a week?" The crucial takeaway here is that every financial bubble follows this exact same tragic 4-stage timeline. First, discovery. That's the initial excitement. Second, the boom, where the crowd piles in. Third, the mania, fueled by that intense get-rich-quick belief. And finally, panic. That's when reality aggressively checks in.
The early buyers do fine, but it leaves the late buyers and leveraged investors totally ruined, just sitting on mountains of unsellable bananas.
Act 5. Spotting the next bubble.
So, the million-dollar question: how do we actually identify these warning signs in the real world before the panic sets in? Well, watch out for these major red flags. When amateurs are making absurd returns with zero expertise, be careful. When everyone is borrowing money to invest in the exact same asset, be careful. When the market is moving irrationally fast, super careful. But the absolute ultimate trap to watch for is when the general consensus vehemently insists a crash is impossible and that prices can only go up. That is exactly when you should be terrified.
But let's be smart about this. Not every hyped trend is a doomed bubble. We really have to distinguish between temporary hype, where things are valuable only because people believe others think they're valuable, and true breakthroughs that create actual long-term value. Think about the dot-com crash. It wiped out countless overhyped companies, sure, but the actual internet was real and it completely changed the world.
Let's apply this to a real-world example right now, the AI landscape. Look, AI can write, draw, and code, but let's be honest, the output is often still pretty shaky. Most of these companies aren't anywhere near profitable yet. Instead, they're being propped up by massive, unprecedented floods of investment capital pouring in, mostly just to keep the appearance of growth alive.
And that brings us to the hardest truth for any investor to accept. It's the fact that two completely opposing things can be true at the exact same time. A new technology, like AI, can be an incredible, genuine breakthrough that's going to change the world and simultaneously be massively, dangerously overvalued in the short term. We've seen it happen before, and we are absolutely going to see it again.
So before jumping into whatever the newest hyped trend is, and especially before borrowing money to invest in it, you need to pause. Ask yourself this absolutely critical question. Am I buying this because it's actually useful, or am I just buying it because I think I can flip it to some other guy for more money tomorrow? Are you chasing value, or are you just chasing price?
I want to leave you with this final, incredibly grounding thought, because at the end of the day, bananas are for eating. Don't confuse price with value. You have to understand the fundamental purpose of what you're putting your hard-earned money into. Bubbles feel incredibly real on the way up, right until the very second they don't. So I have to ask you, when you look at your own portfolio right now, are you holding on to something that provides real, long-lasting value, or are you just hoping to sell appeal before the music stops? Thanks for joining me for this explainer, and stay focused out there.